It has been 8 years now since a majority in Great Britain voted for Brexit. Great Britain has no longer been a member of the EU for 4 years. However, there is little to suggest that the political and economic consequences of this fateful decision have been overcome. Not only does a new survey show how much German and British companies are still and increasingly suffering from forced decoupling. In view of the geopolitical changes, the West's confrontation with Russia, the increasing systemic competition with China, the escalating conflict in the Middle East, a looming second Trump presidency, well, Brexit appears even more anachronistic than it was in 2016. The fact that the British Conservatives continue to carry the idea of leaving the EU like a mantra and brand any doubt about it as a betrayal is part of the loss of reality for a party that has been in power for 14 years and is trapped in its ideology. According to the latest surveys, most Brits are not the only ones hoping for a change of government in the general elections expected to take place in the autumn. The British economy is also tired of the quarrelling Tories and is expecting new impulses from a Labour government in its relationship with the EU. Brexit and its consequences continue to burden German trade relations with Great Britain. Increased administrative expenses, logistics costs and customs duties are proving to be permanently painful. That was revealed by a survey by the British Chamber of Commerce in Germany and the audit firm KPMG, which is available to the German press agency in London. New regulations led to an increasing decoupling of the United Kingdom from the EU. The results were to be presented last Thursday as part of the Ludwig Erhard Summit at Tegernsee in Germany. The decline in German-British trade volume is dramatic, said KPMG Divisional Director Andreas Glunz. Since the Brexit referendum in 2016, the trading volume has fallen from 38 million tons to 22 million tons. British exports to Germany increased again in 2022 for the first time since 2016. The main reason, however, was peak prices for crude oil and gas, which were used to replace lost deliveries from Russia. And Brexit is not over, he says. He pointed to new laws and regulations on both sides of the English Channel. And many projects would be decoupled or not harmonized, for example in environmental policy or in the area of artificial intelligence. The British government wants to invalidate hundreds of laws from the period of EU membership. And the BCCG President Michael Schmidt also warned against further decoupling in view of the geopolitical crises. We urgently need to bring politics and economy of both countries closer together again and build bridges, he says. Great Britain left the EU at the end of January 2020 and has no longer been a member of the EU Customs Union and Internal Market since 2021. And despite a trade agreement agreed at the last minute, there were major problems in the bilateral exchange of goods with the EU, especially at the beginning. And companies will also face further changes this year, including a new British customs model. From the end of April, British importers will have to pay up to £145 per load of food, such as sausage, cheese and yogurt, but also cut flowers. And according to the survey, the business situation of every second company with 52% in the German-British economic area has deteriorated since Brexit. At 16%, the situation has worsened significantly in 23 after 9% in the previous year. And the proportion of companies whose business has been going better since Brexit, however, was roughly halved from 13 to 6% compared to 22. In the German-British Business Outlook, the companies cited increased administrative costs as well as increased logistics costs and increased customs duties as the main burdens. But there are also bright spots, as the survey shows. The KPMG expert Glunz pointed to areas such as digitalization, energy industry and security, and defense, in which German companies could benefit from Great Britain. What is interesting is the fact that 7% of those surveyed are planning larger investment projects with a volume of more than 250 million euros over the 3-year period, said BCCG President Schmidt. Not a single company had this on its books in the previous survey. Britain is facing financial challenges as longer hospital waits, an overburdened court system, and stretched police forces point to increasing demand for public services. Additional financial demands arise from the aging population, necessary upgrades to defense equipment, and investments in the green transition. However, the country's public finances are uncertain. Stabilizing Britain's debt trajectory depends on unrealistic cuts to public services after this year's election. The winners face the task of developing new sources of income. Faster economic growth, which could lead to more tax revenue in the short term, is not in sight. The International Monetary Fund's latest forecasts for the UK are for annual growth of just over 1% until 2026, and measures to increase productivity, such as reforming planning laws, expanding infrastructure, and improving workforce skills, are essential but take time to bear fruit. It's therefore likely that tax rates will be increased, at least temporarily, in order to put the country's finances and public services on a more solid basis. The exact form of these tax increases is important, and Conservative Chancellor of the Exchequer Jeremy Hunt announced the abolition of non-dom tax status during the budget last month, a measure also pushed by Labour. And this regime allowed people who live in the UK but whose permanent residence is abroad not to pay tax on their overseas income in the UK for up to 15 years. Hunt argued the change could raise up to £2.7 billion a year and introduce transitional arrangements to ease the transition. And last week, Shadow Finance Secretary Rachel Reeves followed up by suggesting some of Hunt's loopholes could be closed. Experts said Hunt's changes had already diminished Britain's attractiveness. However, the additional measures could encourage wealthy individuals to leave the country. As both parties look for ways to raise revenue, it turns out that taxes are never victimless. Proposals must balance the need to raise money with protecting Britain's competitiveness, which has already been hit by Brexit and recent decisions under Boris Johnson and Liz Truss, such as increasing corporation tax from 19 to 25%. And Reeves also took up a proposal last week to raise about £500 million by closing the carried interest tax loophole, which allows private equity managers to pay only the 28% capital gains tax rate. Reforming both tax regimes, non-dom and carried interest, has long been considered necessary because they are seen as unfairly advantageous to the wealthy. But politicians need to consider the cumulative strain on the UK economy and the signals it sends. Wealthy people are mobile, and other countries with more generous tax offers are just waiting to accommodate them. Too strong an approach could shrink the tax base. There needs to be an honest debate about the details of the UK tax system, which should be tailored to the needs of public finances. So Hunt's aim to abolish national insurance, which generates more than 150 billion a year, would be irresponsible without a realistic spending plan. Britain cannot promise European levels of public services at American tax rates, especially at the current weak growth rate. If Britain ignores this reality, its problems will multiply. And if you want to know more, the next video is right here in the end screen. I'll see you there. I'll be back.